We are recording, so you know, on the Clubhouse thing, I'm also holding a Facebook Live at the same time to try and, not lose the content. Right, 1600, let's crack on. Hello, my name is Siam. For those of you who have never heard of me, I'm just a normal bloke from Norwich. That's pretty much it. I've got a bunch of businesses, and I'm a trader, blah, blah, blah. But I think with anything, whether you're on Clubhouse, Twitter, Facebook, or whatever, whenever you're hearing some information, if it's new, for example, always fact check it. Always do a little bit of research and always try and understand the context of where it's coming from. So you should never take anything as gospel. You should just literally Google it, see if it fits you, because what's good for someone or one person may be completely horrendous for someone else. And I guess the things that I personally do will definitely be, I guess, risky and dangerous for other people. But this is why context matters. Now, before we open up to the scene, to the people, in the WAP Facebook group, we had Tim Barton, who's given us some starters for 10. He's got two pretty big questions, actually. So I don't want to go spend too long on this, because we're only here for half an hour. At 16:30, I will end this, because I do talk for the country. So the first one that Tim was talking about was about how to actually make profits from investments, as in ones that are running away. So especially if you're in my community, most of us, I think, are in crypto. I'm definitely in crypto. I've got a fair holding size in there now. And I guess where he's coming from, he said, I lost out on Tron in the last bull cycle by not selling. And I'm trying to avoid the same mistake this time, mainly by holding on to Ether, Bitcoin, which I feel are much safer over the long term. And that I do agree. However, with Ether, although I'm very bullish on Ether and Bitcoin, it's never going to rally as hard as some of the shit coins and lower capped coins out there on crypto. And it's a very valid question, because I have suffered the same case. So back in 2017, when I had that public live $25,000 crypto account and I was trading it in real time in front of you all, I quickly grew that from $25,000 to $1.1 million in 4 months. 4 months. And one of the big punts on that was Tron. So yes, it is a shitcoin, but I got in at 3.5 cents and it rallied up to 31 cents. So that was actually the bulk of my, I guess, floating profits. But I was late, and then I got out at 21 cents a share. So it was an absolute barnstormer. I made loads, 6 figures on that. But I got out late, very late. Or 21 cents is not that bad, seeing as it hit, I think, 30. But then I got out of crypto late as a whole in 2018. So if you just look at Bitcoin got to about 19,600. But then effectively I got out properly around 13,000. So all in all, my $25,000 account went all the way up to $1.1 million and then back down to 350. And I was depressed for weeks because I lost like 700 grand in a week. So Tim, spot on question. I think in hindsight, and that is our best tool really, is that you need to take profits along the way. You really do. So I've got a pretty big position in Aave right now, and it's gone absolutely batshit nuts. I mean, I'm looking at it right now. I got in at $120, and it is, come on, Aave, where have you gone? It's now $532. It's just nuts. And so it's gone vertical on that chart. So every bone in my body wants to take profits. So at the very least, when you have ridiculous amounts of profits, so once you've at least, say, doubled your money or tripled your money, at least take your capital out, as in your original state, because then everything is just shits and giggles. It's risk-free shits and giggles. And what you can then do, this is just one potential strategy. This is not advice at all. So once you've taken your capital off the table, so it is risk-free playings, so to speak, you could then chop that into little pots. So you could keep half of it as like a, I'm going to hold for the long term, Ether, Bitcoin, etc. And the other half, just try and maximize it. So for example, last night was a prime example. So those in my trading community as saw this, Aave last night, just before I was putting the kids to bed, hit $500 per Aave. And I had 300 Aave. So it was basically, I sold out and I quickly sold all of them. So it was at 300 times, was it 500? Yeah, $150,000 worth. And my goal was, because it was such an overextending candle, I was trying to get in on a pullback. So And literally, I had to put the kids to bed. And as soon as they were asleep, I got back on. And it was very lucky that my entry buy order, I set it at 451. And fascinatingly enough, the chart didn't actually hit 451. It hit 460 and then bounced off. And I was like, shit. But I actually got filled. So I got 220 odd Arve filled at 451. And then I got the rest in at 470. And now, so what actually happened is I ended up with an extra 27 Arve. And so 27 times, was it 533 right now? That's a $14,000 profit trade in the space of a couple of hours. So you can do, so that is, I guess, an aggressive move. You don't have to do, and I definitely recommend that you don't do that with your main holding. Have like an itch scratching pot where you can dick around and scratch that gambler's itch. Without hurting your main stash. Again, we've had this with Tesla. A lot of my followers, friends, students, etc. we got in at Tesla below $400, or I got in at about 420, and that's done nuts. So yeah, it's a tough one. There's no correct answer. I've got a friend who's religious that when any crypto he gets into, the moment it doubles, he takes that original pot out and then puts it into Ether. And he did very well in 2017, and he's doing very well now because, yes, he's not getting the maximum move, but he's constantly taking out little pots. So that's that. We've been talking for 6 minutes about that, so I want to move on. And then, yeah, so I guess the next one really talks about capital arbitrage. And I spoke about this yesterday, and that everything in investing is a seesaw. You're constantly weighing up risk reward. And then, but you have to also think out of the box slightly. So for example, if you are fortunate enough and you have a business and you know that your business does well. So for example, let's say you have a marketing pillar, for example, like some people call it a funnel, a client attraction journey, whatever you want to call it. Let's say funnel just for ease of words. Well, even with a really bad marketing pillar or funnel, the ROI or the ROAS, the return on ad the return on ad spend can be obscene. So, for example, one of my businesses, for every pound I put in, it turns into £4. And it's done that consistently for a year. So one of my potential seesaws is, do I just take out, like if I was to add total it all up right now, there's probably about $350,000 worth of crypto right now. And so I was thinking, do I leave it in there and go, YOLO, leave it aiming, for the big one? Or do I take out a massive chunk of it, or all of it, and just dump it into my business? Seeing as I know for the last year or so, this particular marketing campaign, £1 turns into 4. That's when Facebook don't ban my ads like it has done right now. Just ridiculous. And so you're constantly weighing up those things. I think probably what I would do is take a big chunk and pump it into the businesses, because at least I know that's money well spent. And if the markets, if crypto does suddenly bomb, then at least I know my businesses are growing as a result. So cryptos have actually helped. Yeah, so Stuart has said that thoughts on crypto extraction, profit and tax. Unfortunately, you're just going to be paying the 10 or 20%, whatever tax bracket you're on. So I've maxed out my CGT already. So every time I'm in and out or making any profits, I know I'm paying 20% of that in CGT. But yeah, and I keep track of it via recap.io. You simply upload or give the API to all your crypto brokers, and it totals everything up. Boom. So yeah, that's that. 12 minutes into crypto. Let's move on from crypto. This is wealth generation chat after all, and I want this to be chat, not a one-way chat, a one-way thingy. And I'm going to open this up a bit because the other question Tim has asked is about HMOs. And so what he said is that he's been looking at HMO property as a way of creating additional cash flow, as crypto shares, gold, etc. do not, they don't create a yield or cash flow. Longer term, I plan to look into my own business, but it's way outside of my comfort zone, yada, yada, yada. Yeah, so he's looking at HMOs. However, he did correctly say, I worry with property that it is the go-to for government to generate more tax, legislate, etc., etc. And you're not wrong. So does anyone here have any property experience? I mean, obviously I've got my own 2 pennies worth, but does anyone want to pop their hand up and contribute? Oh, so Carl's the first one there, so invite to speak. You have the mic, sir.
myself. Hi Sam, hi Adam. Can you hear?
Hey. Yeah, I can hear you, Carl.
Perfect, yeah. Yeah, no, I just thought I'd jump in at that particular point because you're talking about property and tax, and fresh in my email box this morning, got the Property Notify email newsletter. They were talking about the subject of wealth taxes. Obviously, you've got the budget coming up in March. There's a lot of speculation going on about what they may or may not do with taxes. So, obviously, they're looking at stamp duty again, or they may or may not be looking at stamp duty again. It's due to obviously come back on again at the end of March. But yeah, the subject of wealth tax, how they apply it, how it would actually work. Is it just going to be against property? I think there's a lot of speculation about what might go on around that at the moment. Yeah. So
obviously, it's hard to really sort of like last year. Rishi did all sorts of different things which people were not expecting. They weren't, or some were expecting the stamp duty window, etc. But ultimately, we just don't know what they're going to do, and we can sort of forecast as best as we can. But it's hard, especially if you're. Let's say take Tim for example. He's got a meaningful amount of money. It's his life savings, whatever, and he wants to put it somewhere, and for all he could be about to go into an HMO, and all of a sudden, the rug is pulled from under him, and it's game over time. Especially when you see all the sort of the rumblings from the World Economic Forum, where they're saying by 2030 you'll own nothing and be happy, and that this is from all the World Economic Forum. This is out in plain daylight. It's not like a conspiracy. Just look at their website. They're talking about how private ownership of property is a thing that will phase out, and that it was a thing from the 70s. Because property was the whole hype, and the reason every man and his dog is obsessed with buying a house is because the 1970s Thatcher and Reagan era, where they set up the campaign called "Every Man Must Own His Own Home." It's interesting they said man, not woman, but those are the times. And so what happened is that they started massively inflating the property market. So that started pushing things up. But at the time, the inflation basket, so the CPI, the Consumer Price Index, which is where they gauge inflation from, property, so rent and mortgages, was in that basket. But they then started inflating the currency supply massively since the end of the Bretton Woods system. And property started going up, which meant that this basket of metaphorical goods was rallying, which meant inflation was going nuts, and it was hurting what they wanted the market to believe. And so they took out property from the CPI basket, which is nuts. I mean, like rent and mortgage is like one of the chunkiest things that everyone pays for every month. And so if that is constantly going up, that is one of the main indicators of inflation. So you can't just remove it. And yeah, but fast forward 50 odd years, everyone is obsessed with HMOs. I think in my personal 2 cents, it's been done to death, and the yield is just shit. You got sections.
I think what irks me specifically about this though is the fact that they're focusing on it as a wealth tax. Now I know it's going to be aligned to property, but the whole concept around taxing wealth, and I know we've all got to pay our fair share and everything else. I'm not saying we should focus on one group of individuals or another, but it's the concept of wealth as a dirty word when the definitions of it is there are various different definitions of it. Some relating to oversupply amongst some individuals, but I think we've got this sort of politicization of it as well, and some kind of confusion, because on the one hand you've got Boris's government talking about allowing everyone to level up, so you'd assume that's kind of trying to elevate sort of relative levels of wealth around the country and get everyone up to a certain amount. But you've also got this kind of squeezing this perceived minority of people and demonising the accumulation of wealth. So I think it's just interesting the language they're using in terms of the tax as well. So
yeah. Definitely. And also I'm just trying to make points because my memory is awful. You have to look at where the main distribution of wealth is, or the main concentration of wealth is in the UK, and also not just the UK, the US as well. And it's in land, typically land. Yeah, so that's why there's so many agricultural tax reliefs. So if you have, a farm, etc., and that's because of that aristocracy. They're very cash poor, but they're hugely like asset rich. They have thousands of acres, etc. And so I think if you have land, or especially agricultural land, I think you're always going to be fine. But one of the reasons the UK, mainly London, is still a hotspot, financial hotspot in the world, not just Europe, but the world, is because the UK is the world's best at accounting. We have more accountants per capita than anywhere on the planet by a country mile. And so during the fall of the British Empire, we knew, those that were in power knew that, we had massive countries rising in the east and west, and that we were losing our grip. India just booted us out. The US booted us out a long time ago. And so we then sort of pivoted into an intellectual powerhouse, which was accounting, which is why, British Virgin Islands, Cook Islands, all of the Belize, there's so many tax havens. And so that, and it all came out in the Panama Papers. Originally, this was like a conspiracy theory. And then the Panama Papers comes out, and David Cameron's dad was doing it and all sorts. So I think this is why I think one of the best things that you could actually learn, and I need to slap myself on the wrist because it's on my to-do list, is to become better at tax avoidance, not evasion. It's worth understanding tax evasion as well, so you know when not to cross the line. But the grey area between tax evasion and tax avoidance is huge. And I know lots of people that operate firmly in the grey centre, knowing that if they can grow amount of money, like this amount of money, and they know that they'll just get a slap on the wrist, when the HMRC or IRS moves the goalpost, and what is the fine going to be? So basically, is this extra profit going to be more than the fine that I'm going to get? Yes. Okay, then do that. So
don't fall into the Jimmy Carr or the rolling heating trap. You'll be all right.
Yeah. I feel sorry for Jimmy Carr. I think he was made a massive scapegoat. But imagine being Jimmy Carr, right? You're a comedian, best in your class. You're worth millions because of what you do. So all he would have done is gone and paid good money to the UK's best tax specialists, etc. And they would have gone, we could have done this, here's a trust. And he would have gone, okay, is this legal? And they would have gone, yes, it's legal. You sure? Yes, it's 100% sure. We've got precedents, other people are doing this, other accountants. Okay, I'll set up the trust then. Go for it. He would have obviously written them the big fat check or retainer, done it. But it's just HMRC moving the goalpost, and all of a sudden, he's like, shit, I'm now a scapegoat. So, but going back to HMOs, because I do want to keep on opening this up a bit, the reason I don't own property is because of ROCE, return on capital invested. For me, let's say I plonk a bunch of money into an HMO. Yes, you can refinance, take it out after 6 months, etc. But what is the return on capital invested? What is the yield of an HMO? You're absolutely lucky to get 5-10%, especially after clause 24. Don't know what it's like in the US now, but I can see here there's a couple of people from the US. I've just clicked on some random people I don't recognize. Nikki, I think you're in Austin, Texas. Oh, Austin. It's a massively growing tech hub that now. But for me, it's the yield. I don't get out of bed for anything less than 25%, and even as in ROI, or return on capital invested. So that's why I don't bother with property. Does anyone else have any contradictory thoughts? It's all very well hearing about me, but any contradictory thoughts or elements we haven't talked about?
What about flipping as opposed to HMOs?
Yeah, flipping. Yeah, at the end of the day, if you're a property flipper, you're not in property, really. You're a business owner. It's no different than buying a bunch of face masks at 10p a face mask and then selling them at £1 a face mask. It's just normal capital arbitrage. And if you're selling a house, yes, obviously you need to know about property, but the risk is less there. If you can, especially if you're a tradie, I know a bunch of tradies that do really well. Like if you're a builder, plumber, electrician, etc., they go and buy a rundown house, they do it up using sweat equity. They can get, they can put 10-20 grand's worth of electrical fixing up and whatever, and they get their mates in as well. And then all of a sudden, they've pumped in 50 to 100 grand's worth of sex equity there. It's a different topic. That's another clubhouse chat. And then they can flip it. So that, you're in and out relatively quickly. So, yeah, that's cool. I mean, Tom, I just see Tom is here. You're in the property world, mate. What are your thoughts on HMOs at the moment? Oh, I need to invite you. Sorry.
Hopefully you can hear me now.
Yeah, I can hear you, mate.
Yeah, I was in the property world, but unfortunately I had to give it up. It didn't go well for me at all in the end, managing the number of HMOs that I took on.
Oh, wow.
I'll certainly share some thoughts on that.
Yeah, please. Honestly, I love learning points. So, like, obviously everyone says, oh, property is amazing. So, you've been at the coalface. What happened?
Yeah, so I started a rent-to-rent business, ran it for probably, I think, cumulatively about a year and a half. Initially, it kind of starts off well, but admittedly, I think I didn't do the calculations right on the HMOs that I took on. They just really weren't that profitable. And I took it on a time in my local area, Oxford City, where there seemed to be a real kind of change in the dynamics and the demands for the room types. So I came in aiming for quite a, I don't say at the highest level, but certainly quite a boutique level of rents at a time that the general quality of people in Oxford looking for rooms seemed to be wanting a much cheaper level. So despite fighting away through it for about a year, I just lost so much money through voids and whatnot. I got to a point I had no other option but to put the company into liquidation at fairly short notice, basically.
Yeah.
So, and yeah, in hindsight, I think I got quite suckered into the whole personal development world and all that. Oh, you can do it, and financial independence is the way forward, financial freedom.
Yeah.
You can earn £1,000 a month in HMOs. And when you sat there, getting nervous every time your phone goes off at 10 o'clock at night because you're worried a pipe might be leaking, you realise it's not quite as funny as you thought it might be in the first place.
Yeah, true. Like, and we all go through that. It's not just property; it could be anything. It could be setting up a podcast business or any business. Okay, so what was your main learning points then? With hindsight,
so much from it, really. I mean, for me, it's I still take the full responsibility in terms of it came down to me not doing the calculations as well in the first place, so probably being too over optimistic based on the whole kind of the typical self-help buzz. B, I probably should have taken ownership of the issues much earlier, so probably tried to find a way of avoiding liquidations and just closing the company down in a better way, because I had to leave some people with some debt, sadly. Yeah. And, I think the biggest thing for me is the one thing I'm still trying to overcome is the kind of self-doubt that's put in my overall entrepreneurialism.
Yeah.
But learning that it's natural to fail, and you shouldn't take that as, the end of your, not the end of your life, but the end of your venture.
Yeah, yeah, definitely. And like, I invest in businesses. I guess I'm an angel investor, and I would much prefer to invest. So if we had two identical people, one has had a liquidation and has been in business, and there's someone that has their first business did really, really well, I would actually feel far more comfortable investing in the person that's had that knockback, because the one that's had a clean record so far, they're not battle tested. They obviously. They may have lucked in with a really good business model and they've done really well and got it out there, so that's great. But you don't know how they're going to cope under pressure with cash flow issues and complaints or whatever it may be. So you are right now a far more investable person. So whatever you've lost there, I don't know how much money it was. That's actually an investment in your experience.
Thank you. I mean, I'll take that. I think the one thing I'm grateful for, on the most part, is I'd certainly lost a much more substantial amount of money than anyone that I left with a small amount of debt as a result of the liquidation. So, I think that would have made it far worse if I had ended up, going down a JV route or borrowing finance or anything for anyone. That probably would have just mentally destroyed me far more than I would have been more comfortable with in terms of managing my own finances. Yeah,
definitely. And so last question on that. With the HMOs that you had, did you make any yield on any of the properties? And if so, what was the yield? Was it less than 10%? If you look at each house in silo.
I haven't got the numbers to hand. It was around, at full occupancy, I was making around 15%, give or take.
Per year?
Sorry, say again.
What, per year? 15% averaged out? Okay, that's not bad.
No, so it wasn't bad, but it was just that when you start to look at a more holistic view, that was made up of probably a few good months, but it quickly came to the voids just ate into that so badly that by the end of years, it was like, no, that yield's gone entirely. So, you were in a good place, but you've just lost out.
Fair enough. Awesome, mate. Awesome feedback.
But I think that it's just the risk of it. And like you say, it's the learning point of as much as you can study business and you can get inspired, from even people like yourself, Siam, because there's clearly some very successful people out there, and there's some great people, including yourself, that's willing to share much of that knowledge. Until you go through a lot of that, and until you are, you're managing your own books, you're looking at your own P&L, and you've got to manage cash flow quicker, you can never be prepared enough for it. You really can't.
Definitely. And it's good that you can share your losses. I know a lot of people that wouldn't share it, whereas I think I take pride in all my hiccups, and I make hiccups all the time still. So Tom, thank you so much for that. And Andrew here on the Facebook Live, he says, I've been running a professional 6-bed for the last 4 years and returns 11% per year on investment. Cool. Is that gross or net, Andrew? The last year with COVID has been a problem with professionals going back home to live with parents. Yeah, that's so true. Personally, I wouldn't do another. Yeah, that's good. It's always good to get the other side of this, because the moment you start Googling or YouTube property type stuff, you will, enter someone's funnel, so to speak, and then you'll only hear the hype. And I guess with anything, I don't care what it is, whether it's trading, business, property, podcasting, setting up a clubhouse business, whatever, it's always a 5 to 10 year play. Always. And don't look at it anything less than that. Your first 5 years will be you dicking around, learning. That is it. And if you make profit in your first 5 years, good for you. But at some point, yeah. So I just embrace it. Don't worry about failure. So, and Andrew, he says net. So yeah, 11% net, that's not bad. But so going back to that Roki point, for me, real inflation really is, probably anywhere close to 10%. So that's why I don't get out of bed for anything less than 25, because I don't want to effectively break even. And when you look at the M2 currency supply in the UK or anywhere in the world, just go to worlddebtclock.com, I think, or just Google world debt clocks, and you'll see the amount of debt and currency that's been printed. So you just got to keep in front of that. Right, so that's 30 minutes. As I said, I'm going to keep these short, sharp, and sweet. And yeah, thank you for everyone that's been here. So we've got a whole bunch of people on Clubhouse, so nice one. I've actually recorded this because I'm holding a Facebook Live at the moment, so this will go out in the WAP group. And so one of it's closed. Anyway, so yeah, thanks for that, folks. And I've got 3 minutes left. Sorry, I've got lots of different things here. They all have the different time. So yeah, in fact, let's leave it there. I'll be here on Monday again. So I'm trying to hold these little wealth generation chats on Clubhouse at 4 o'clock UK time every weekday. So Monday to Friday. So I'll see you here on Monday, hopefully. Right, toodles, everyone. Love you. Bye.